Your tax-free account does exactly what it says. So why does £100 of American dividends arrive as 85? £15 left before your broker ever saw it. It went to the United States, and it isn't coming back. Now look it up, and you'll be told the same number everywhere, 30%. For you in a UK account, it's wrong, and I'll show you where it came from. Quick note, none of this is financial or tax advice, so please do your own research. Same company, same payment, 5 different ways to hold it. That's the board, and I'll fill it in a row at a time. And one of those rows isn't decided by the law at all. It's decided by whoever happens to hold your account. There's a UK investor who did everything right, took it all the way to the Ombudsman, the independent referee for disputes like this, and lost. That's the row to stay for. Every row on that board is decided by 2 questions. What wrapper the shares sit in, and whether one piece of paperwork got done properly. Start with the paperwork. America charges a default 30% on dividends leaving the country. That's the headline rate, and it's real. But there's a tax treaty between Britain and the United States, and for a UK resident, it cuts that to 15%. You claim it with a form called the W8BN. And here's the bit people get wrong. You don't send it to the American tax authority, you hand it to your broker, and your broker holds it. Most UK platforms fold it into signing up, which is why an awful lot of people have signed one without ever noticing. So, what happens when you put all that inside the wrapper nearly all of us use? Say you hold Coca-Cola. An ordinary American company pays 4 times a year. About the simplest example there is. Now put it inside the tax-free wrapper, the one on screen, the one most of us are using. That dividend still arrives with 15% already gone, and that 15 is a dead loss. Which sounds like an oversight, and it isn't. It's just how the 2 systems meet. Relief for foreign tax exists to stop you being taxed twice on the same income, so it needs a UK tax bill to sit against. Inside the wrapper, the UK doesn't tax that dividend at all. No second bill, nothing to credit it against, so it stays gone and it can't be carried forward to some future year either. That's row 1 done, and it's the one nearly all of us are actually sitting in. Next is the row people ask about most, and the one the internet gets flatly, confidently wrong. American property shares, REITs. Every forum, every comment section, the same line. REITs don't get the treaty rate. They get hit with the full 30%. It isn't true. Not for you. A UK private investor holding an American property share gets the same 15% as any other American share. The treaty doesn't even use the word REIT. It treats them as pooled investment vehicles, and it attaches 2 conditions. You have to be an individual holding no more than 1/10 of it, or under 5% of a publicly traded class. Buying through a UK broker, you clear both without trying. 30 only bites above 1/10 of the whole vehicle. A landlord-sized stake, not a portfolio one. So where did the myth come from? Geography. 30% is completely correct if you're investing from Singapore or anywhere else without a treaty. There's a mountain of that content. It's well written, it ranks, and British investors read it and assume it applies to them. 2 rows down and they agree with each other. The next 3 don't, and the first of them is the most expensive mistake on this board. Now the row that catches people out. No form at all, or a form that's quietly gone stale. Then you're back to 30%. And here's the part that stings. Even if those shares sit in a plain dealing account where foreign tax can be claimed back, the treaty rate caps the claim at 15. So the extra 15 isn't deferred and it isn't recoverable later. Nobody ever sees it again. And you're probably thinking, I signed one of those when I opened the account, I'm fine. Maybe. The form expires. It runs to the end of the 3rd calendar year after you sign it. Most platforms will prompt you, but the renewal is yours to start and nobody is obliged to chase you. And 2 more things get repeated that simply aren't right. Handing over an American tax number doesn't make the form permanent. That rule ended over a decade ago, and the 3-year clock still applies to us. And you don't need to refile because you moved house. Not within the UK. Moving to an American address is a different story entirely. 3 rows down. Which leaves the pension, and that's where this gets uncomfortable. Pensions. If those American shares sit inside a SIPP instead, the treaty says 0, not 15, nothing. A pension scheme is exempt, and that includes the property shares we just looked at. On paper, it's the best row on this board by a distance. On paper. In 2021, a UK investor complained to the Financial Ombudsman about exactly this. Their pension provider had been applying 15% to their American dividends instead of 0. They'd read the treaty and they'd read it right. The complaint wasn't upheld. The decision is public. It's on screen. The provider's position was that it had no obligation to apply a 0 rate to pension holdings. And the Ombudsman's finding, word for word, applying the reduction is a commercial decision made by the businesses involved. That sentence is the whole episode. The treaty tells you what you're owed. It doesn't make anyone press the button. Most platforms hold shares through a pooled nominee account, everybody's stock sitting in one name. And getting a 0 rate through that structure takes work that somebody has to choose to do. So row 4 goes on the board with an asterisk, which leaves 1, and it's the row nobody thinks of as tax efficient at all. No wrapper, a plain dealing account, shares held in your own name. The 15 still goes, but this is the only row where you can get it back. It goes on a self-assessment return as foreign tax credit relief, and it comes off your UK tax bill. There's a cap, the lower of the American tax paid or the UK tax due on that same income. Which raises an obvious question. If the unwrapped account is the only one that recovers the 15, why would anyone hold American shares in the tax-free wrapper at all? Because the 15 isn't the only tax in the room. Outside the wrapper, you then pay UK dividend tax on the whole lot, above a small allowance, at rates that went up this April. The relief hands you back one bill and leaves you holding the other. Inside the wrapper, that second bill doesn't exist. Which is the last row. So, one company, £100 of dividends, 5 ways to hold it. There it is. And every row came down to the same 2 things. Your wrapper sets the rate you're entitled to. Your provider decides whether you actually get it. And the honest read, 15% is the price of admission for American income. Whether that's worth paying is your call. Losing another 15 on top because a form went stale. That one isn't. One thing could change this board next year. It's proposed, not law, draft legislation, out for consultation, and it only happens if it proceeds. A new charge on the interest your uninvested cash earns inside a wrapper. Not dividends, not your investments. Interest on cash you've left sitting. If it's confirmed, I'll go through it properly. I went looking for one number and found 5. If that was useful, subscribing genuinely helps. Until next time, happy investing.